Let's start with a simple, almost sacred rule of capitalism. If someone walks into your shop with money in their hand, you smile, you take it, and you say thank you very much. Business schools don't spend 4 years teaching that principle for nothing. Customers are the point. Volume is the point. Cash flow is the point. Which is why what happened on Monday, January 19th, 2026 should make anyone paying attention sit up a little straighter in their chair. Because on that day, one of the biggest precious metals retailers in the United States effectively said, actually, no, we don't want your money. An emergency communication went out from Ken Lewis, CEO of APMEX, the Amazon of gold and silver. This wasn't a promo. No free shipping, no limited time offer, no cheerful subject line. This was a corporate distress flare shot straight into the sky. Effective immediately, APMEX instituted a mandatory minimum order size of $500 for all online purchases. Now, $500 doesn't sound dramatic if you're moving serious capital. For the whales, it's pocket change. But for the average person, the one buying a single ounce here, and there to protect their savings from inflation, this isn't a speed bump. It's a locked door with a polite sign taped to it that says, "Come back when you're richer." So the obvious question is, why would a business do this? Why would a company voluntarily turn away customers, especially when demand is exploding? APMEX ES official explanation is that this move is designed to help them return to normal service levels. That's the corporate version of, everything is fine, please remain calm. Let's translate it into plain English. They're drowning. Their systems are straining under the weight of panic buying. Orders are flooding in faster than they can process, package, and ship them. And when a retailer starts rationing, because that's exactly what a minimum order requirement is, it's a sign they've lost control of the flow. This isn't about maximizing profit anymore. This is about slowing the bleed of metal leaving the vault. In other words, they're prioritizing the whales and quietly sacrificing the minnows. And here's where it gets interesting. This letter doesn't just confirm demand. It confirms the type of hours of demand. Lewis explicitly states that silver demand has far surpassed gold demand over the last 6 weeks. That detail matters. Gold is the asset of central banks, institutions, and sovereign balance sheets. Silver is the asset of the public. It's the people's metal. When silver demand overwhelms gold demand by this margin, it's a signal that the average citizen is waking up. They're realizing the dollar in their pocket is losing value faster than their paycheck can keep up. This isn't speculative greed. This is defensive behavior. People aren't chasing gains. They're running from erosion. But the most unsettling part of this letter isn't what it says outright. It's what it implies. If APMEX had unlimited silver, they wouldn't be turning customers away. They'd hire more staff. They'd add shifts. They'd expand logistics. They'd gladly ship you one coin at a time because every order, no matter how small, is still profit. The fact that they were willing to turn away what they admit is roughly 50% of their order volume tells you something critical. Profit is no longer the priority. Survival is. They're circling the wagons. What we're watching is the early stage bifurcation of the retail precious metals market. If you have capital, you can still access metal, though you may wait longer for delivery. If you don't, you're being gently but firmly nudged out of the lifeboat. This $500 minimum isn't the end of the story. It's the opening chapter. Ask yourself what happens next. Does the minimum move to $1,000? $5,000? Remember, they already implemented a $10,000 minimum for sellback orders earlier. Now they're restricting the buy side too. This isn't random. It's tightening. And all of this lines up perfectly with what we're seeing on the price chart. Silver is trading at $94, an all-time high. In a normal functioning market, high prices, cool demand. People hesitate. They wait for pullbacks. But APMEX is telling us the opposite is happening. Demand is accelerating at record prices. That's not normal behavior. That's a Giffen good scenario, an economic paradox where demand rises as prices rise because the asset is perceived as essential and scarce. People aren't buying silver because it is 94. They're rebuying it because they reafraid it won to be available at 94 tomorrow. They're not thinking about price, they're thinking about access. And based on this letter, that fear isn't irrational. Lewis admits they're working long hours, weekends included, just to keep up. That's a system running at 110% capacity. Anyone who's ever worked in operations knows what that means. Systems at max capacity aren't efficient. They're fragile. One more shock, one more demand spike, and things start snapping. For the individual investor, this letter is a warning shot across the bow. The era of casual access is ending. You can't just wake up, decide to buy a single coin, and expect frictionless delivery anymore. That convenience is gone. Now you have to plan. You have to pool capital. You have to compete with larger buyers. The democratization of silver is quietly reversing. We're drifting back toward a world where precious metals are the domain of the wealthy, the institutional, and the well-connected. And remember, APMEX is the biggest player in the room. They have the deepest pockets and the strongest supply chains. If they are rationing, imagine what's happening at your local coin shop. Imagine the smaller online dealers without APMEX's relationships and infrastructure. Chances are, many of them are already dry. The $500 wall isn't just an inconvenience, it's a signal flare. The physical market is under stress. Friction is rising. The velocity of metal is slowing, not because people don't want it, but because the system can't process the demand fast enough. This is what a physical liquidity crisis looks like. There's plenty of cash. What's missing is logistical bandwidth, and the data points in Lewis's letter make this even clearer. CEOs don't share internal numbers unless they're trying to explain something breaking down. In this case, he revealed that Saturday, January 17th, was the third busiest Saturday in the company's history. Volume was 4 times a normal Saturday. Let's pause on that. Saturdays are usually dead in precious metals. Spot markets are closed. Banks are closed. People are at soccer games or mowing lawns, not hammering refresh on a bullion website. A 4x spike on a Saturday isn't organic growth. It's not clever marketing. It's panic. It means people spent that weekend reading headlines about mint suspensions, tariff wars, and systemic stress, and decided they couldn't wait until Monday. They wanted their money out of the system immediately. This is what a modern bank run looks like. Not lines around the block, but servers melting down on a weekend. And that's the real takeaway here. This isn't about silver coins or minimum orders. It's about trust. Trust in currency. Trust in institutions. Trust in access. When that trust erodes, behavior changes fast. APMEX didn't suspend capitalism for fun. They did it because the rules stopped working under pressure. And when the largest retailer in the market starts saying slow down, it's worth paying attention. Because if you thought it was hard to buy silver yesterday, just wait until tomorrow. One detail that keeps getting overlooked is the timing. All of this demand exploded before silver ever touched $94 on Monday. These buyers weren't chasing a breakout. They were stepping in at $89, $90 plus premiums, happily paying over $100 an ounce when you factor everything in. And they didn't hesitate. They bought 4 times more than usual. That single fact alone punches a hole straight through the deflationary narrative. We're constantly told that when the economy rolls over, consumers freeze, that people pull back, hoard cash, and stop buying anything non-essential. Yet here we are, watching real people panic buy a hard asset at record prices. Not because it's cheap, but because they're afraid it won't be available. That's not theory, that's behavior. And behavior always tells the truth before the data does. The CEO's letter goes further. He notes that last week ranked as the 4th busiest week in the company's entire history. Pause and think about what kind of weeks would normally sit at the top of that list. The 2008 banking crisis, the 2020 COVID crash, the silver squeeze of 2021, those were once-in-a-generation events. And now, quietly, without a formal declaration or a flashing red banner on CNBC, we're right back in that territory. This isn't normal market activity, it's an anomaly, a historical pressure point forming in real time. But buried in that letter is a data point that's even more revealing than raw volume. The CEO explicitly states that silver demand has far surpassed gold demand, reaching a new all-time high as a percentage of company revenue. This is the poor man's gold thesis unfolding live, without filters or academic footnotes. Gold is trading around $4,600. For most families, buying a 1-ounce gold coin is not a casual decision. It's expensive. It feels heavy, both financially and psychologically. Silver, even at $100 an ounce, still feels accessible. You can buy a tube, you can hold it. There's a sense of quantity, of substance. It feels like you're getting more, even if the math says otherwise. That unit bias matters. It's not rational, but markets are never purely rational. That perception is pulling capital out of gold and funneling it into silver. And here's the critical part. The silver market is tiny compared to gold. When that wave of capital shifts direction, it doesn't gently raise the waterline. It overwhelms the system. It's like forcing fire hose pressure through a drinking straw. Something is going to burst. This leads us to an uncomfortable realization. The paper price of silver is being set by algorithms that watch the dollar index, bond yields, and interest rate expectations. The physical price, however, is being set by a retail crowd that no longer trusts the system those algorithms are built on. These two forces are speaking completely different languages. The algorithm sees high rates and thinks, sell silver. The public sees the US Mint shut down and thinks, buy silver. And right now, the public is winning. A 400% weekend volume spike doesn't lie. Physical buyers are no longer a sideshow. They're the dominant force, and the paper market is struggling to keep up. Before moving deeper into the supply breakdown, there's something important that needs to be addressed directly. This channel exists because of trust. We spend hours dissecting CEO letters, reconciling vault data, and connecting dots that aren't obvious on the surface. And unfortunately, just like there's fake paper silver, there are fake channels now too. We've seen a surge of copycats using the same AI avatar, lifting scripts, duplicating thumbnails, and hoping viewers won't notice the difference. So let's be absolutely clear. There is one original channel. This one. We are only on YouTube. We are not quietly running accounts under different names. We are not selling crypto on Telegram. We are not asking for money on WhatsApp. Anyone using this avatar outside of this channel is not affiliated with us in any way. We do this work because we respect the audience and the intelligence of the people watching. We want you to have real data, not a watered-down imitation. If you want to help us fight the noise, go into the comments and type, "Staying with the original." It matters more than you think, and yes, we read every single comment. Now, back to the data, because this is where the situation turns from serious to dangerous. Demand is hitting all-time highs at the exact same moment the US Mint is closed. Normally, when demand surges, a dealer just picks up the phone and orders more coins. That release valve doesn't exist right now, so APMEX is forced into the secondary market, buying silver back from customers. But here's the problem. Sellback orders are dropping. Even at record prices, people aren't selling. They're holding. They don't trust that they'll be able to replace what they give up. So now you have record buying pressure colliding with shrinking selling supply. That's not a slowdown. That's a supply shock. And then comes the line in the letter that should make anyone involved in this market uneasy. The CEO admits that their internal production output will be impacted by approximately 50%. Not 5%, not 10, 50. This is the smoking gun. APMEX isn't just a retailer, they own their own mint. They produce the vast majority of their branded silver in-house. They control the labor, the machinery, and the schedules. In a normal world, with demand surging, they'd be running triple shifts and burning the lights 24/7. You only cut production in half under one condition. You physically can't produce. And that points to a problem upstream, specifically silver grain. Silver grain, or shot, is the raw feedstock of the minting industry. You melt it, cast it, punch blanks, and stamp coins and bars. No grain means no product. It doesn't matter how many workers you have or how many orders are waiting. If the feedstock dries up, the machines stop. If APMEX's output is down 50%, it means refiners are only delivering a fraction of what they used to. The tap has been turned down. The obvious question is why? Is the metal gone, or is it being redirected somewhere else? To answer that, we have to look east. While this letter was being written, the Shanghai Gold Exchange closed its Monday session. The silver fix in Shanghai printed at 1326. That gap matters. It suggests physical silver is being pulled toward markets where it's valued differently, where demand dynamics aren't driven by Western paper contracts. This isn't speculation anymore. It's logistics. A 4x demand shock has collided with a 50% supply cut. Do the math. Demand up 400%, supply down half. That gap doesn't close with optimism or press releases. It closes with price. And clearly, $94 isn't high enough yet. Demand hasn't broken. Panic is accelerating. Supply is tightening. And the largest dealer in the country just told you they're running at half speed. This isn't a drill. This isn't a chart pattern. It's a real-world failure of the silver supply chain. And in the next phase, we're going to dig into why dealers are refusing to pre-sell inventory, and what it means when even they don't know if they'll be able to source metal next month. Because if the dealer doesn't know, neither does anyone else. At some point, you have to stop listening to slogans and start doing arithmetic. Because once you run the numbers, the situation becomes uncomfortably clear. The spot price in New York is hovering around $94. Meanwhile, the spot price in Shanghai is effectively $103 when you account for the local fix and delivery dynamics. That's roughly a $9 spread per ounce. And that spread isn't theoretical. It's an open invitation. If you're a global refiner sitting on silver grain, you're not debating philosophy or patriotism. You're running a margin calculation. On one side, you sell raw material into the U.S. retail chain at $94 and deal with stressed mints, delivery delays, and retailers begging for volume they can't handle. On the other side, you cast that same silver into kilobars, ship it east, and pick up an extra $9 an ounce with a buyer who can take size and pay immediately. Guess which phone call gets returned first? This is why APMEX can't get grain. The Shanghai market has become a magnet, pulling raw material out of the global supply chain and dragging it across the Pacific. The United States isn't short on demand. It's being starved on purpose by price arbitrage. And that explains why premiums are exploding. The premium isn't greed, it's desperation. It's the dealer trying to outbid Shanghai just to keep metal on U.S. soil. But at $94 spot, they can't win. So they charge you $115 or $120 just to cover replacement cost, assuming replacement is even possible. That brings us to the second policy shift buried in the CEO's letter, and this one should make anyone holding paper contracts uneasy. Ken Lewis wrote that APMEX will no longer pre-sell inventory more than 30 days out. That sentence alone tells you the futures market, at least for retail, is functionally over. Pre-selling is standard in the bullion business. It locks in prices, hedges exposure, and smooths operations. Dealers have done it for decades. APMEX just walked away from that entire model, not because they suddenly dislike it, but because it no longer works. If they sell you silver today for delivery next month, they're taking a risk they can't quantify. What happens if Shanghai gaps higher next week? What happens if refiners raise grain prices overnight? APMEX would be forced to buy metal at a loss just to honor contracts already sold. That's how businesses die. So they're not selling the future anymore. They're admitting, quietly but unmistakably, that the price mechanism is broken. They have no visibility beyond the next few weeks. This isn't a temporary pause, it's a slow-motion force majeure. The future is too volatile to promise. What replaces it is hand-to-mouth trading. You can only buy what physically exists right now, and even that inventory is disappearing. Combine that with a 50% production cut and mandatory minimum orders, and what you're looking at is the collapse of the retail distribution network. The paper price on the screen still says $94, but that number is becoming irrelevant. You can actually transact at it. The infrastructure that moves silver from refiner to mint to dealer to your hands is coming apart. Refiners are bypassing U.S. mints. Mints are rationing output. Dealers are rationing customers. And the public is left holding dollars that buy less access by the day. This is why the tariff news matters so much. The government sees the metal leaving. It sees refiners shipping supply to China to capture arbitrage. Tariffs are an attempt to build a wall and keep that metal here. But capital behaves like water. It always finds a crack. And right now, the crack is profit margin. So what's the verdict on the production collapse? It means this supply shock isn't temporary, it's structural. Until the New York price rises to meet Shanghai, silver will continue flowing east. The U.S. Mint can't fix that. APMEX can't fix that. Only price can. We're entering a market where availability matters more than charts. If you see silver in stock, that's the signal. Not RSI, not moving averages, inventory. Premiums will look insane. The chart will look overbought. None of that matters anymore. Buying silver now isn't about investing. It's about securing. You are locking in a claim on a finite resource that S being reallocated to the other side of the world. The CEO of the largest dealer in America just told you he's running out of capacity, visibility, and metal. That's not a warning. That's a status update. So what happens next? When the primary market for newly minted bars breaks, the pressure doesn't vanish. It moves sideways. Like water hitting a dam, it finds a new channel. In the silver market, that channel is junk silver, and the name does it no favors. Junk silver is pre-1964 U.S. coinage. Dimes, quarters, half dollars made of 90% silver. They're not junk. They're constitutional money, leftovers from a time when the dollar actually meant something. The key difference is that junk silver doesn't need refining. It doesn't need a mint. It already exists. It's sitting in bags, vaults, sock drawers, and coffee cans across the country. When the supply of new eagles and bars dries up, demand shifts immediately to this secondary supply. And here's where things get interesting. In a currency crisis, you don't want a 100-ounce bar. You want fractional silver, you want something you can actually use. A silver quarter buys groceries. A 100-ounce bar buys awkward conversations. The smart money understands this. Dealers are already scrambling to buy back old coinage, but people aren't selling, they're preserving. That's Gresham's law on steroids. Bad money gets spent, good money gets hoarded. Paper dollars move, silver coins disappear. We're likely to see junk silver premiums detach completely from spot. If you can still find 90% silver at anything resembling a reasonable price, that window may not stay open long. From there, the market goes peer to peer. If APMEX has a minimum and your local shop has empty trays, you transact directly. Private sales, cash deals, handshakes, no screens, no tickers. In that world, the spot price is a punchline. The price is whatever the seller says it is. If you're holding silver, you become the central bank. You don't sell at $94, you sell at replacement cost. And if replacement is impossible, the price is whatever clears the deal. That's not speculation, that's decentralization. The banks have lost control, dealers have lost capacity, power shifts to whoever holds the metal. So here's the bottom line. The paper era is ending. When the CEO of the largest dealer can't plan 30 days ahead, the system is unstable. Minimum orders, production cuts, and canceled pre-sales aren't temporary policies. They're defensive moves ahead of a price reset. Inventory is being protected, not sold, because higher prices are coming. Strategy 1, don't be picky. Rounds, bars, junk silver. Weight is weight, atoms are atoms. When silver is $200, nobody cares about the artwork. Strategy 2, watch Shanghai. As long as that price gap exists, the drain continues. The US price will have to jump to close it. The short squeeze everyone talks about is now being driven by a physical squeeze. Banks are trapped. Dealers are trapped. The public is trapped. The only exit is metal. Thank you for trusting us with your time. Information matters. Clarity matters. And once again, a reminder, we are boring currency. The original. Not on Twitter running scams. Not on Telegram selling dreams. Leave a comment saying, staying with the original to show your support. The dealer has spoken. The factory is broken. The supply is gone. You have the information. What you do with it is up to you. Stay safe. Hold on to your constitutional money. Welcome to The Shortage. Subscribe.